Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, we'll go through the market update. We'll review some of the earnings trades that are out there, and then Joe has his chart analysis at the end. Let's get started. Okay, we look at indices all still, state one holding in one's sectors. We only have the real estate XLRE in state two, XLU5, but everything else still in ones. Big pie, we're still over 45 on state ones. It's kind of been holding. Pie obviously moves slightly higher, but not a lot of action yet. So just kind of holding on for that grinding higher. Here's the chart for state ones and state eights. So let's see here. Last week we're slightly over, 48, 49, about 50 now. So nothing really moving quickly. Those have gone into twos, any of the drops for the past few days, but not a whole lot of movement as far as the different states. Kind of the more important thing I'm kind of tracking right now is the new highs. We're still in a bullish. We had what's that, Thursday had a nice spike, 570. Past 2 days dropped a little. So we're just kind of being on guard for kind of a switch over from where it's here, like showing bullish, and then flips over. So that would be a big warning sign. We start seeing lows pop up and things like that. But this is still telling us, we're still got the green light, as of Thursday. Even Monday was fine too. So we're still having elevated highs, and this is kind of where we are, just grinding higher. You can see the charts. Obviously, we had a little pullback, but we've had those all along the way. So until this switch is over, just into something where we're getting lows and starting to get turn downs in here. We're just kind of level. I mean, from back here, December, it's pretty much just been kind of flat for state ones, like right around there. Up and down a little bit, but pretty flat. So, this is like, I think the key indicator to watch here on a daily basis. And, if we start getting spikes and transitions and, big movements, that could be another indication. So, it's the same thing with the, bullish, bearish overall. So that's all bullish states, all bearish states, same type of thing. We tried to cross here, then it's been grind up to 60, and we're just kind of chopping around that 60 part. So, that's where we're at there. Let's take a look at SPX here. So, we're still in state one, been a heck of state one, 95 trading days. It's hard to believe that went into state one back in November. It's been holding ever since. Like I said, we're fairly close to the largest move ever in state one, but we'll have to keep grinding higher to do that. Other than that, I think our levels are going to come from the chart. We're pretty much way off the state modeling levels here. Okay, so let me get the tool out, see if I can get the numbers I want. There you go. Tool. Okay, so this bottom range, 5,000, top range off the chart here, 5,400. So, the key thing here are the trend lines. So this is your 20, sorry, gave me the wrong one. That's your 20-day, that's your 50, way down there's 200. So the 20-day has been support this whole move up. You can see, I think only closed once below there. So we got sort of close. Yesterday, you can see the 20-day was 51.79. So we were within, 5 points of that, and it pretty much bounced off of that. So that's our near term support level, 51.80, and that'll go up each day as we keep trending higher. But that's the critical level. Obviously below that would be 50-day. Bottom of the range 5,000, and the only thing to the upside right now is the current highs, which is not like a huge resistance level unless it starts turning into one, showing that it's going to 52.60 there, 50, say 52.60, and it keeps bound, turning that into like a resistance where it can't get above that. But other than that, it's kind of top of range, 5,400. These are all-time highs here, 52.64. So that's where we're at on the SPX. Clear. Let's go to Russell. Or Russell. We last meeting we had a feeling it would make a run over 2,100. It did. Only lasted 3 days. 1, 2, 3. So it's back below here. We'll see. Like I said before, last week, the longer we hang around here, the more I expect it to actually break above and hold above 2,100. But we did get above 21, so it's new highs for this current state. We had 21.15 there, so we got up 21.35. Obviously back down lower, but 2,100. We expected that to be strong resistance. It has been. Longer we're here, the better it is. The more chance we'll break above it. So we're back, for time being in our 21 down to the 19 range. The 20-day doesn't really come into play here, but the 50-day is a big one. You can see all along this move, 50-day, it has been the trend support, 200s all the way down at the bottom range. So 2,100, still expect that to be pretty good resistance. But like I said, longer we're up here, better chance we have a break above that and hold. All right, so the 50-day moving average is 20.30. I think we're like 30 or 40 points of, about 40 points above that right now. So I haven't gotten close to that, since February. You had one little touch here in March. You can see here, March it was 2006 and 2007 right there. And, the low got right close to it and it just, exploded off of that. Next day, gone. So these are the two things I'll be watching for the indices. There's 50-day on the Russell and 20-day on the SPX. See if this trend can break, along with this kind of monitoring. Monitoring the highs and state transitions. That should give you a good clue, if this thing starts to turn. But in the meantime, it's just like here, new highs, lots of green. It's a green light right there. So okay, what else we got? Oh yeah, 10 years popped up quite a bit. So we always worry about this. So it got up 442 today. I think part of the pullback is, spike in rates here um, from last week. So we just want to be, we definitely, when we get up this level, or even I think kind of over 4 or 5, it's, definitely a headwind. And especially for the Russell, that's most correlated, inversely correlated to rates right now. So above 4 or 5, I think it's ugly. Obviously up here, got up to 5. That's real bad when the market, for the market when we're up there. So let's keep your eye on the 10-year. I had a little bit of spike here, since his bottom, 379-ish. It's just keep making new highs pretty much. So I just made a new high. So, just this thing gets over 4 or 5, just be careful. So, I think that was it on that. Fed had a little bit of movement here. So, um, yeah, nothing for May. So June was expectation for the first cut. So that's moved a little bit. Um, looks like it just updated. So it's moved a little bit. So, it's 37 here was 29. Pretty much no way you're getting more than one cut. Still kind of one cutish, but it's moving a little bit. Same thing, less cuts, just kind of shifting like it normally does, um, to less cuts over time. And so it's still, kind of June, July, first cut probability, moving more towards July. And then not too much here, just shifting a little, but still kind of 3 cuts for the year as of now. So, okay, last thing here, the balance sheet finally crossed that 7.5 trillion. So we talked about that a lot. I guessed it would happen in March, and the last week of March it actually barely crossed. So we just talked about this the last time we had overnight funding. Basically QE bounce back was we were running off here as about a 15% runoff ish, and the overnight rates just started spiking. Uh, kind of a mini crisis, and they just turned on the spigot and uh, here. Then obviously when that's COVID. So we're in that kind of window. I haven't seen too much on banks recently. Just here's and there's on like commercial real estate kind of issues, but nothing too much on banks so far. So, but we're kind of in that window. It's been almost 9 trillion, so 1.5 trillion. Um, it's not chump change, but I think kind of offsetting this a little is fiscal spending by the government. We're definitely spending a lot, and government's spending a lot, so I think that's helping offset this a little bit, but could still be problems, and I would think we'd see that in like overnight lending rates, also in in the 10-year. So okay, I think that was it on the market. I'll open up to questions, comments.
Josh, this is Dave. Great comments. I wouldn't argue with anything you said. I think it's right on. Be interesting to see what Joe says about future projections here in a few minutes. But,
Mhm.
I'll wait. We'll comment after Joe does his piece there. But yeah, it's interesting to know or to see, to observe that the 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 expectations for cuts have gone from 6 to 3.
Right.
The market has gone up all during that time. So, when articles say, well, that's baked in, or this is already baked in. Well, I don't know whether it is or not, or ever is baked into whatever the current rates are. So we'll
Mhm.
see. It's yeah. I've been feeling that. I think Bostic just came out and says, well, probably maybe just one this year. We'll see. We'll see if more Fed speak kind of gets toward there between now and the end of. I think the next Fed meeting is the 1st of May or something like that. So
Yeah,
um, we'll see. Like next catalyst is going to be earnings in a couple of weeks here, so we'll see how that goes.
right. Yeah, and I was just looking up, JP Morgan's kind of beginning of the earnings, so that they come in the 12th. That's the banks, so next week.
Yeah, Intel
Sorry.
didn't lead the way with very encouraging news yesterday, with all the money that's coming their way in the CHIPS Act. Yet they're like the highest losses ever, I think, reported for their mainline businesses. So that's a different story too. How far out into the future are investors willing to stake a claim? I think they were talking towards like 2030 before the foundry business is expected to be profitable, which is their new line of work. So it's interesting to watch and see how that unfolds, because that's a
You're talking about Intel, right? Yeah, were you talking about Intel, Dave?
Yes, he was.
sorry,
Okay,
I muted myself. Yeah, I was talking about Intel, and
yeah.
because there was a big hoopla ribbon cutting event for their groundbreaking stuff, that factories that they're starting to build now with the help of a whole bunch of money that the
Mm-hmm.
taxpayers are throwing their way. So it's interesting. The U.S. government's going to be an investor in Intel, but I don't know how the private the private investing group or the hedge funds are going to put their money in a company that's going to take numerous years yet to get back to kind of where they were or where they once were. So it's an interesting story to follow along. Yeah,
Right. Yeah, they got some catching up to do. Huh?
definitely catching up to do.
Okay. Yeah, thanks, Dave. Okay. Anyone else before we let's do a quick earnings run here? Okay. We only have 4 trades open, all bullish. So let's hope the market stays bullish. We got a bullish runner as ACN. A little down today. So it's almost where it was on entry, down just slightly. So still got time there. We entered that on the 22nd, so should have like another week or so on that. Then we got the bullish pre-runners. Got 3 of those. Capital One that came out yesterday, and then Monday was Hilton and American Express. So early innings, we'll see. We've had some bad Q1s before, but you know, um, hopefully this time's different. Market is looking, bullish so far. So we'll just have to keep track of these. But just the start of earnings and the first real kind of earnings, big picture wise, or kind of start next week. So that's it on earnings. And you can always go in and pull up the quarterly plan and kind of look out and see what's coming, trade dates and all the different types. So, all right, that's all I had. Any questions, comments on earnings or anything else before Joe takes over? All right, Joe, I'll hand it over to you.
All right, Josh, let me grab this screen here. Thank you. Let's see. Sorry, I'm not sharing yet, am I?
No.
Okay, hold on a sec. Yeah, let me, there we go. All right. Hi, everybody. Thanks for joining. And thank you, Josh. Let's see, gotta believe surprise is still to the upside here, despite, the lack of correction. So I'll get into a few charts, but I did want to go back to something that I mentioned a little while ago, just that we're nowhere near where I think it's important, but just to reiterate, from time to time, maybe you check on this, and it is that differential in the AAII sentiment reading. When we were doing a little comparison back to the late 90s and the tech explosion, what I thought was most important about this, this reading is the differential between the bulls and the bears. And just to reiterate, at the highs of, that tech bubble, the differential was somewhere between 45 and at one point 61%. Basically, there were no bears. The bears were single digits to, a few of them. A couple of the readings were, 11 and 12. We've got 22% bearish now, which is, a pretty low number. But that differential's only about 23 at this point. And I just think, that's something that will give us a darn good idea of extreme, when we get there. Certainly prices will be, in the stratosphere at that point, I'm sure. But just wanted to go back and mention that again. As Josh pointed out, we're triple digits, in our current days in a few of these, and XLK has led the charge by a day, at 101 days, XLC right behind, along with NDX, so triple digits, and not what are we? I think we're somewhere between 35 and 45 days to the all-time run in state ones in these indexes going back to 2007. So the charts, and I'm going to go through a few numbers, a few different ones, but I don't know if I've mentioned this guy before. On LinkedIn, he is an analyst for Fidelity Investments, Jurian Timmer, Timmer. I think he comes out with great stuff. Oftentimes it's longer term perspectives, and he had one in the last week. Talked about secular bull markets, and he talked about from 82 to 2000, and even predating me and many of us, from 48 to 49 to 68 as another secular bull. Certainly, I remember I traded, was trading the entire time between 82 and 2000. Remember that very, very vividly. But and in terms of secular bulls, his opinion is he thinks this most recent one started in 2009. Go back and look at his readings, and he says there's a lot of opinion out there that started in 2013, because I guess there were new highs in the indexes then, and that's when some people think that the secular bull started. His opinion is 2009. So just kind of got me thinking, wanted to go back and just look at these charts, look at another thing that got me thinking about it was, I told Josh, I was going to do the retracements, and I'll pull up some retracements in the charts, but before I even put the retracement tool in there, I was laughing. There are no retracements. There are no pullbacks. And, I think we all know that at this point. I think it just speaks to the strength of the market. Dave was talking about, the potential catalyst of earnings coming in the next week or so. And I think that's exactly what that will be. That will be the next excuse for this market to take off, would be my best guess. So, again, just looking at the longer term, and if we go back to 2009 and the lows in the indexes, SPX, NDX, and Russell, the basically retracements I just wanted to review because, looking for something now, there aren't any. So, going back to, okay, what did we get coming out of the COVID lows, in our bear market of end of 21, 22, what did we get? And I don't think anything like this is coming anytime soon, but I just want to review kind of what we got in the different indexes. And as you can see, we got basically a 50% pullback in SPX, whatever that level, was exactly, ballpark 3,500. But, we did get a nice retracement in that bear market. And I think last week I was talking about, your typical cyclical bull market, maybe 3.5 to 5 years, starting in 2022. We're 17, 18 months in. So it would suggest that, still, really a long way to go in terms of time. And we believe that earnings are going to continue to accelerate. We may have plenty of upside still to go. There's SPY, NDX, we've talked about, I bottomed around 1,100 in 2019, or excuse me, 2009. And, I think we all recall it was the techs that got, beat up the most in our 2022 bear market. And it's turned out, they get down to that 5/8 retracement, where Russell and SPX basically just touch 50%. And, it's part of the reason why, when we took off coming out of October of 22, the techs did the best because they had gone down the most. And, you can see the almost parabolic rise coming out of October of 22. And here's the Russell, basically, basically did a 5/8, or excuse me, a 50% retracement, coming out of, the COVID low and the run up after that. And so earnings in the S&P, what did I, and again, I think this whole thing is going to be driven by earnings. And for a long time, earnings in the S&P were running between $20 and $40, for the whole index. Let me see. Basically, in the early 2000s, S&P earnings were running basically between 60, 40, and then $60 again. And of course, we're talking 200 plus at this point, 225, 250 for the S&P 500. So coming out of these 2009 lows, the S&P is going up by almost 8 times out of the 2009 lows. NDX over 17, far and away, the biggest winner. And then, pulling up the rear is the Russell at about 6 times. Those multiples are coming out of the 2009 lows. Earnings, basically in, I think it was 2000, the financial crisis, S&P 500 hardly earned any money. And, we're up, like I said, north of 200 at this point. So just the shorter term charts, and really, I almost didn't put these retracements in just because, we haven't seen any. But last 6 months, coming out of the October lows, a 3/8 retracement here is going to be somewhere around 48.50, something like that. I don't think there's any chance in heck that we're getting anywhere near there in the S&P. And that would be a 3/8 retracement. Josh laid out, I thought, some really good stuff, with those new highs and new lows. I think, he's definitely onto something there. If you see something picking up in those new lows, well, chances are, the market's going to be rolling over. But there's absolutely no indication of that. And I think I had reviewed some of that a while back where those new highs can run, the spike in new highs can run for an awful long time. And I think that's exactly where we are at this point. So SPX, just as Josh pointed out, just continues to churn higher. Nothing different in the NDX. The only thing a little bit different in the NDX is, we kind of took off. We've been a little bit, more sideways, but that's because I think, the run was greater. And, we all know some of these numbers that have sort of flattened out after these parabolic rises, to a point. So, I think it's the simple, new lows, new highs. And, here, what are we looking at? We're talking about, lows in the 17.3 range in NDX. And, are we going to exceed the high at 18.5 basically? So tight ranges. And, I think the catalyst will start next week with these earnings. There's Russell, had a couple more red bars in Russell, but that's been a laggard consistently. And I think, as Josh and I pointed out over time, part of that is that I guess 40% of those 2,000 aren't even making money at this point. I want to go back to the leader, XLK, kind of mirrors NDX, for sure. So I guess what is it? I think it's 212. If you're looking for the next leg up now. I'm sorry, down around 205, I guess, was yesterday's low. So, if you're looking for a trigger for, the market taking off again, I got to believe XLK above 212 would, be a pretty good signal. Now, I think it raises the question, is it going to be this group that leads again? I don't know. We've had, a little bit of broadening. XLC, which I don't have that chart up, but that's right behind in terms of days. XLC, yeah, also in triple digits. So that's certainly been a leader too. If we get a next leg of the market here after a pause, will that leadership, come from those two areas again? I'm not sure, but that's why, following the price action is so important. Yeah, just Dave does a lot of homework in the semis, and I think the number for Intel is, I think the government's given them $6 billion, and Dave, after you mentioned that, I did. Let me see. Here's the Intel chart, and we literally are trading right here at this point at yesterday's low at 40.5. That's where we are right now. So it'll be interesting to see whether it holds. This is something where, yeah, certainly you can run some decent retracements coming out of these lows, in October. And, hard to say how much time, the market is going to require, in terms of the benefits from all this new stimulus going to Intel specifically. But there's, one of these semi-indexes, so like 212 in the XLK, this thing's basically up around 240. We're a little bit of a ways off that, but other leadership for sure. Last one, just TLT, just talked about it. Nothing super significant. We have been in a state 8. We get stopped out, from a technical standpoint in that state 8. Ultimately, that has been correct. But, I can't imagine anything too dramatic is going to happen here. This looks like, the range in rates has lifted a little bit. And, to Dave's point earlier here, we've gone from 6 or 7 cuts to 3, and the market's, going up. So I think that just speaks to the importance of earnings and the fact there's so much liquidity in the market. It's looking for a home, and a lot of that home, I think, is price earning multiples expanding. So that's all I had. Happy to talk to anybody about any comments, questions.
Hey, Joe, Dave, I got a couple actually.
Great.
Back with your 2019 to where we are now, good charts. The only thing I want to point out there is that's the only time that's happened in history. That bearish drop, then bullish outcome for the next year and a half was like never. That was the first time we ever saw anything like that in history. So it was a unique period in time, and one thing I think we could all say, everybody that's on this call, and say, hey, I was acutely aware of one of the most in one of the most unique investing timeframes in history, because that's what it is, or and is and we're still coming out of it. So it's all pretty interesting to me. So so it is unique, and all these you know articles that I read. So, well, if history shows this should be what happens next. Well, my point is, like, this has never happened in history, so I don't know how this article is valid whatsoever. Yet you see them all over the place. The other thing I wanted to say was getting back to Intel. One of the comments that Pat Geislinger, the CEO, was making yesterday, and he was very thankful, by the way, to Biden and all of the people that backed the CHIPS Act, was that one CHIPS Act is not going to undo the 30 years of neglect that U.S. investors have, provided the semiconductor industry. So part of the issue getting, back there was all the outsourcing that happened. We shipped a lot of a lot of labor intensive chip issues overseas for cheap labor back in the day. And then a lot of the companies in the industry found that it was like very difficult to manage an operation halfway around the world that's doing part of your work to the other part of the organization that was back in here in the United States before we shipped it overseas. And I'm not making this up. I have two brothers that work in that industry, and that's precisely what were telling me for decades. It's like, this makes no sense. Why are we even doing it? But there were CEOs and various companies came and went because they were banking on this. Well, we're going to make so much money because we're reducing our expenses on some operations that we're shifting overseas. And now we're seeing that didn't pay off, and now we're 30 years behind in our investment scenario from a global perspective, from U.S. investing perspective, U.S. global investing perspective. And you neglect something for 30 years, you can't get it back in like one day or one 4 or 5 year cycle. It's going to take more to get it back. That's why I think the Intel picture is going to be an interesting one to watch going forward. They are I'm just repeating what Intel's been doing, but they've started kind of like a new business area that's altogether different than what they had been doing. And it's going to take time for that to, for those seeds to blossom and, investors to reap returns on that. So we'll see how patient they are. But it's our quarter over quarter, year over year thought process in the US that's losing out to the 5 year over 5 year or 10, 20 year investment strategy that our competitors overseas tend to use for investing. So yeah, it's short-term gains or long-term pains. That's what the semiconductor industry is teaching us here. It'd be interesting to see if we can get it back. Intel's got a lot of money now, and a lot of backing from the government for a while. But they're behind, so we'll see how fast they can catch up to the competition. Anyway, interesting to keep watching. That's one sector I watch all the time, so it's fascinating, if you ask me. Thanks. And thanks for your comments there. I think they were right on in the where we're going now. You and I both have been expecting sort of a pullback, haven't seen it. But some of the Mag 7s are starting to roll over a little bit. Tesla and Apple, for example, are now quite a bit lower than they were, and they're dropping off on the Mag 7 to Mag something difference now. So we'll see how Apple turns out this earnings review. I think that'll be maybe again, that week is the telltale week for me as to where things are going to go for the quarter. So either I'm going to stay be bullish, or I think maybe we might have reached the plateau a little bit. Maybe we'll see a basing and plateauing here for a while in the SPX and the NDX. That would, to me, be encouraging if we at least saw a plateauing and not more grind forward, but we're in a grind forward mode, so we'll see. Anyway, thanks for your comments.
If Sure. If we happen, the earnings, start to come out and the market takes off again, do you, Dave, or anyone else have any comments about where the leadership in the market might come from?
Well, you mentioned my name, so I'll tell you, it has been coming from AI, but I don't think it's going to be coming from AI unless we see some of the companies that have been all over, we're investing big in AI, can prove that their investments are paying off to the bottom line. And I don't know how they could do that because they don't really break it out in their quarterly reports at all. So I don't know. It'll be interesting. It's not the new thing that's going to continue the growth that we've seen over the last couple of quarters. AI specifically, that's what I'm talking about. The who's going to lead? Well, the FANGs. What were the FANGs that led? They were all the big cloud companies, right? FANG was kind of cloud. If you had a cloud, those are the companies that were hauling in the big bucks since 2020. Cloud companies. What are the AI companies? Oh, well, some of those are actually cloud companies too, right? So some of those that are cloud and AI sort of related will probably be, in my opinion, those will be that to answer your question, those are the ones that I would say would be at the top end. Whether they are going higher or maintaining their highness is two questions and two potential outcomes there, but I don't think they will drop as much as some of the other companies that have been professing a whole lot of AI capability. If they can't prove that they're generating earnings and revenues from what they've been talking about for the last 6 months, I don't think they're going to go a whole lot higher. So I don't know if that answers your question.
I think your point's a very good one. It's valuations obviously have jumped more than significantly since October, and so we've got a couple more quarters now where they have to basically put up or shut up to defend these prices. So the next month in terms of the earning releases should really be interesting. I mean, I left the Intel chart up here. You're talking about their earnings. I mean, now granted, the October earnings cycle, you got to gap up. And the very next quarter, now granted, the stock was up, 15, 20%, but you got to gap down, the very next quarter. So just no consistency there. And, it will be interesting to see the market's reaction to what these companies deliver over the next 4 to 12 weeks, I guess.
Yeah, you said like
anybody
Apple.
Else?
I'm sorry, with Apple.
Go ahead.
I'm sorry again, I apologize. But with Apple's perspective, specifically, they've been criticized for not having an AI story, but that's because iPhones aren't AI where AI is going to happen. And I don't think the normal retail investor has any idea of why I made that statement. But they don't have a good AI story to tell. That's why Tim Cook hasn't been out there, pounding the table for we're going to have an AI product here for you soon, and hang on, it's going to be a great thing. Now, when I was looking at the SPX, for example, and a shorter fib retracement, I was looking at just the other day. It looked to me like the first fib retracement was back to right around 5,000 in the SPX, which is that big round number that we've talked about before. I think you and I sort of expected to chop around at 5,000, and it just kept blowing through there. So I think that I showed my fibs were a lot shorter than that. Maybe they weren't.
Right.
Maybe they weren't. Maybe that was the one. It
No,
kind of comes out right at 5,000. Yeah, you had the right.
Okay,
And
then
the first major one is back to like 42 or 48.2, I think, the first critical fib retracement level. So
that's a long way with the strength of this market. I mean, it just seems to me like there's no chance. But
Yeah,
we'll see.
yeah, I think that the pullbacks will happen eventually, I think, but and maybe they'll come to these levels, but it won't be a quick retracement, in my opinion. It'll be like it's been a grind up. I think it might be a grind down until like there's some unified thinking in market sentiment that says we're too high, too low for a while here. So right now, I don't think anybody knows. So they're willing to just keep on the momentum trend bandwagon there. So that's the way I'm playing it too. Not what I'm
I
thinking,
don't
but what I'm expecting other people think. That's the way I've been trading.
I don't see any chance of a slow grind down, none whatsoever. I think if we get, a correction, there's going to be some catalyst, and it's going to be violent and fast. And as far as the upside, can we continue to grind or explode up? As I've been saying for a while, I think surprises continue to be to the upside. And in terms of another catalyst, we've got non-farm payroll on Friday. Excuse me.
Yeah.
I think they're looking for 200. That's always a number that the market looks to. 180 private, 20 out of the government. Was what Trading Economics had on their site. So and then next Wednesday and Thursday we get CPI and PPI. But I'm guessing it's really going to be all about earnings.
That the jobs report, the payroll, the inflation reports, are all like kind of 1-2 day news. When bad ones come out, they're bad for a day or so, and then the market says, we can live with that anyway, and it goes up again after that. That's the way all of those news kind of things have been playing out for the last, number of quarters. And news is short-lived usually.
Anybody else?
Hey, Joe,
Okay.
Dan here. Can you hear me?
Hey, Dan. Yeah, loud and clear.
Yeah, on your question as far as what would be some potential leaders, I think in the short term, there's a possibility that energy could continue to lead, especially if things continue to escalate in the Middle East. We've got increased military action with Israel, bombing Iran and things of that nature. There's a lot of military machinery heading in that direction. That could choke off the supply ships out of the straits there. I think that could have an impact and make we could end up having like an oil embargo like we did back in the 80s. That's one of my concerns there. The other one is the gold has taken a pretty good run, and to me that tells me that there's a lot of people are insecure as far as the value of the dollar, and they're going after that as a holder of wealth. So I think, and plus commodities have been relatively inexpensive, and it seems like those are becoming more expensive. But the thing that I can't help but notice was the inflationary picture from printing money over the years seems to correlate with an increase in the stock market over time. So the way I'm looking at it is even with the earnings, the costs are passed on to the consumers. I mean, now you can spend $1,400 for a cell phone, and over $1,000, for a PC and things like that. So that's being passed on in spite of the relatively high interest rates, and then you get the government gifts like the money going to Intel and things like that just bolsters it even more. So I think the rising market is actually a cause of all the inflated dollars. I think it might hurt. It hurts the consumer more than I think it does the companies. The companies become more valuable because they can always pass the prices on to the consumer, you know, and they're charging more for a widget, and it increases their bottom line, you know. So
Totally agree with you, Dan.
that's
And
what that. Just my 2 cents, but that's that's what I'm looking at.
I appreciate it. And I totally agree with you. I think, first time in a generation, the companies for the most part had pricing power, and they're not giving it up. I mean, we go to this, wherever, we're shopping. Prices are high, and, the size of the bags are still shrinking, and, that falls right down to the bottom line. So totally agree. And the energy, pulled that up. I mean, it's been a heck of a run. It's interesting that, the ETF is right up to target 3 at this point. So, it'll be interesting to see whether that proves to be any sort of resistance here. It's had an awful good run already, but certainly could be an area of continued leadership.
Yeah, I think as this administration tries to push everything towards EV and away from fossil fuels, I think it's a pipe dream because everything is made, just about everything is made with fossil fuels. You're not going to make plastics without it, and rubbers and things like that. So I think that it's not going to go away. I don't think that fossil fuels are going to go away by any means, and if they make them scarce, it's going to become more expensive. So
Thanks, Dan.
you're welcome. Thank you.
Joe. Robert
Anybody
here.
else? Hey,
Yeah,
Robert.
Joe. Robert, yeah. I have to agree with Dan, and I just dropped the link in the chat to Bollinger Band's website, and chart 45, the sector grid, pretty much confirms what Dan had said.
Will that pop up here?
Yeah, sure did.
And then you just go to chart number 45. You scroll down. Yeah, click there where you see. Yeah, there you go.
Okay. And just
Yeah, chart.
see.
It won't pop there. I think you have.
Okay.
I usually just scroll down.
Okay. Oh, okay.
There's a lot of them there.
Yeah,
We can get down there. Here we go. Here we go. We're getting there. Thank you, Robert. Let's see.
Yeah, I typically take a look at this periodically, see what's there. There we go.
Yeah, I can't. A little bastardized here with the thing on the bottom. Sorry.
Yeah, I'm on my iPad, so I'm getting the same thing you're getting.
Okay. Yeah, look at that energy. Way up there, top right.
Yeah, that's the leading quadrant right there.
Yeah. Mm-hmm. Golden energy right there in commodities. Well, that's an interesting link, Robert. I hope everybody maybe can grab that. Looks like there's an awful lot of information here. A lot of information out there. I think part of the keys is just trying to, figure out your own recipe. I think most everybody on the call has it, their key sources. So, yeah, fun to put it all together. It's a 21-day moving average, Josh.
Oh, yeah, yeah, close enough.
That's on the Dow. That's on the Dow. Yeah.
Yeah,
Mm-hmm. Okay. Thank you, Robert.
yeah, it's a good link.
Anybody else? All right, Josh.
Okay, thanks, Joe. Great questions, guys. Anything else before we wrap it up? All right, we'll do it again next week. Thank you all for tuning in.
Thanks, guys. Good
Thank
comments,
you.
Dan
Thanks.
and Robert.